Hi everyone, very good afternoon ladies and gentlemen. Joining us today live on Zoom and Facebook for the webinar on COVID-19 and economic era unfolding. Casey is indeed grateful to have organized this webinar in partnership with Ceylon Chamber of Commerce and the Daily FT. To understand what the future might hold and how we can shape those outcomes, we need scenarios to bound the uncertainty and help us understand the underlying drivers of outcomes. We intend to help business leaders out there to prepare and gain an insight on the new future ahead, which has not been written in any books thus far. To begin this session, I'd like to extend my greetings and warmly welcome our panelists. To begin with, Dr. Chandranath Amarasekara joining us today, Director of Economic Research from the Central Bank of Sri Lanka. Mr. Manjula de Silva, Chief Executive Officer of the Ceylon Chamber of Commerce. Mr. Amal Sanderatne, Chief Executive Officer and Founder of Frontier Research. Mr. Shiran Fernando, Chief Economist of the Ceylon Chamber of Commerce. Mr. Travis Gomez, the Product Head at Frontier Research. The webinar for the day will be moderated by Mr. Nistar, who is the editor of Daily FT, a well-known individual in the business world and who himself does not need an introduction. Dear participants, a few ground rules before we begin. We kindly request you to mute your microphones and make sure that your video is turned off at all times so that we can avoid any disturbance which are to be caused. And also, you may also send your questions on Slido, sli.do, the website, with the event key hashtag NC19 so that it could be posted to the panelists. The webinar is also being live streamed on facebook.com/kseedslk. Now, I'd like to invite Mr. Nistar to head the event from now onwards. To Mr. Nistar.
Yeah. Thank you very much for everyone for finding time to be with all the web audience and on the invitation of all three partners of this event. What we will do is invite the key panelists to make some opening observations and then we will take some questions from the moderator as well as from the public as it depending on the responses. I'd like to invite Dr. Chandranath Amarasekara to make his opening remarks in terms of the state of the economy and given the recent developments.
Thank you, Nistar, and it's a pleasure for me to join this forum organized by KSeeds. And thank Mr. Rohan Senanayak for inviting me and organizing this event as well. I must mention that that the views that I express here are not necessarily the institutional view of the Central Bank of Sri Lanka. In my introductory remarks, I thought of outlining the key areas that I would like to elaborate on during my presentation later on, and also update you on a couple of latest developments on the monetary policy front. I've got a few slides to show you. Yeah. Can you now see the slides? I'll assume that you can see the slides. And the COVID-19 pandemic has caused an unprecedented humanitarian and economic crisis of a global scale. For most national and multilateral organizations that are in existence today, this is their first experience in handling a crisis of this magnitude. Unlike any other global recession, the recession caused by the COVID-19 pandemic has to be dealt with while economies of almost all countries are in a lockdown with limited domestic and even smaller global trade and other transactions. Countries around the world have used broadly 5 types of policies to address challenges that they are facing. These could be categorized into border control, public health sector policies, fiscal measures, monetary measures, and capital flow management measures. The first 2 of those, border control and public health related policies, are aimed at containing the spread of the virus. Fiscal and monetary measures seek to provide relief to businesses and individuals affected by the pandemic and revive the lockdown, revive the lockdown affected economies. And the capital flow management or foreign exchange related measures attempt to mitigate the impact of the balance of payments and exchange rates. And similar to other countries, Sri Lanka has also taken a series of measures covering all these aspects. These measures have been discussed at various fora and are available through numerous media as well. Information is available through numerous media. Therefore, I will not elaborate or even attempt to summarize them in this forum. But let me highlight one key development in relation to monetary policy that we saw just last evening. I think this has covered it very well in Daily FT. The central bank has reduced its key policy interest rates, what we call the standing lending facility rate and the standing lending, the standing deposit facility rate and the standing lending facility rate by a further 50 basis points to 5.5% and 6.5% respectively. With that, the central bank has reduced those two rates by 150 basis points within a matter of 4 months this year. Another key highlight of the Monetary Board discussion was that it is disappointing that the reduction of policy interest rates and large liquidity injections have not been reflected in market lending rates. The board has emphasized in very strong terms that if banks and other financial institutions fail to bring down lending rates within the next few weeks, there will be regulatory action taken to remedy this. This shows the urgency for such reduction, as the recovery of the economy depends on reasonably priced financial sector support to the broader economy. I believe it is time that all interest rates in Sri Lanka are brought down to sensible single-digit levels. Let me also highlight another recent development. So this is what I was talking about, the monetary policy decisions thus far. Every month, if you see, if you look at the timeline, every month we've taken one or two monetary policy decisions in addition to the various other measures that we have taken. The second highlight that I would like to note is the publication of the annual report of the central bank last week. The annual report is the flagship publication of the central bank, and it discusses developments in 2019 and in the first 4 months of 2020. It summarizes the expectations for the near term and the medium term. It also highlights the issues and challenges that the country needs to address going forward. Some of these aspects covered in the annual report will be addressed in my presentation later on. Thank you very much, and I look forward for a fruitful discussion. Thank you.
Thank you very much, Dr. Amarasekara. I move on to Shiran Fernando, Chief Economist of the Ceylon Chamber, to make your own observations.
Thanks. Thanks, Nistar. Let me first share the screen of the presentation as well. Great. So in the context of what's going on, I thought I'll initially run through a few slides to talk through a bit of the narrative as well of how we are seeing things winding down. I think this chart has been flashed around a lot by a lot of forecasters and in some of these forums, but I think the key part here is that what was earlier thought of to be an optimistic 3.3 has now very much gone into a -3% for the world as per the IMF. And some of the key advanced economies is sort of what is dragging down a lot of the growth. But even this is very much limited in terms of the assumptions. I think there are a lot of things that could change. The IMF has also made it known as well. And I think as you go on, you will see further revisions, which will even come much sooner. And then to show you this as well, the recovery from the global financial crisis in 2009, you saw a lot of forecasts made and subsequent revisions. So if you look at historical perspective, this is chart sort of outlining how the IMF, for example, forecasted growth over the early 2010s, in 2011, 12, 13. Most of it was for this sort of a V-shaped kind of a recovery very quickly post the 2009-10 crisis, but it never really materialized, and subsequent every time you saw sort of revision. So I think we'll come into that scenario where as more data comes in, as more assumptions are made, we'll really know the real gravity of this impact. And I think past examples might not really provide the impact as well. From Sri Lanka's perspective, pre-COVID as well, I think it's very important to understand that it was in a very low growth environment. If you look at 2019 numbers, we've essentially gone back 2.3% growth in terms of US dollar. We've gone from being an $89 billion economy to 84 billion. And per capita also, we've gone from being above 4,000 to now 3,800. So we're very much gone back, if not even 3-4 years. So the impact of COVID would really even be a further setback. We might see potentially another recession much more deeper than what we did see in 2001, which is sort of being forecasted, I think, by a lot of the analysts and a lot of the forecasts by some of the international forecasters. So, for example, IMF is minus 0.5. I think that will be even much more longer. But interestingly, a lot of them are seeing this sort of quick uplift next year, which is optimistic if it does play out that way. But I think we'll have to really see the reality of it in terms of whether it will actually take place. But I think this exercise of figuring out whether it's going to be V shape or U shape or W shape or L shape is a very difficult exercise, because you can only do it very much retrospectively, and different economies will shape out differently. And in Sri Lanka's case, we are sort of hit by the third black swan in under 2 years. So we saw the constitutional crisis in October 2018, then the April 21st attacks last year, and this as well. And this is really going to stress the system. So even though maybe growth will recover next year, it's still way below potential. So our base really has a big impact. So a U-shaped recovery in that sense can be achieved next year if the adequate stimulus measures are put. So far, we're really seeing only the monetary lever being utilized by the government in this recovery. We're not seeing too much of a fiscal lever, given the lack of fiscal space and also the limitations with the borrowing limit as well. So in the absence of fiscal space, we're really seeing the monetary lever being used. The key part of this also has been what happens in terms of the currency. And I think everyone's eyes were glued to the rupee moving towards 200 earlier on. Now it's sort of come back. I think there's less imported demand pressure right now with some of the restrictions put in as well, and potentially central bank intervention as well. But when you look at it from at least the start of the year to some of the latest points, we're not too bad relative to some of the other countries. From a maybe 2 or 3 year perspective, we've depreciated quite significantly, but at least this year, some of the other countries, in particular the Indonesian rupiah, the Thai baht, have done much worse than we've done. So from a relative perspective, I think it's very much lower. And one of the reasons why some of these other countries have not done too well is the massive outflow that we've seen from these markets as well, which has taken place quite significantly and at a faster pace. And I think that's sort of highlighted on the graph on the left. But the good thing from Sri Lanka's perspective is the outflows, the major part of it, I think now has happened. We've seen more than 400 million go out this year. And we're almost at the bottom, 25 billion, which also might leave depending on how the exits happen. But the downside risk from that, from a debt perspective and also from a rupee perspective, is very much limited. So that's sort of a saving grace compared to, say, 2015, if this happened in 2015, where we had close to about 500 billion in foreign holdings of government debt. As Chandranath mentioned, I think the clear strategy has been from the central bank for more than a year now to really bring down interest rates. We've seen the prime lending rate fall over 4% since February 2019. These also move in cycles, so this COVID really will put this current cycle into a real mix as well, to see whether we'll really see the central bank trying to keep rates lower, but where will the impact on the economy really come from? The other aspect also has been, I think, given the need to finance the government and also keep liquidity in check, we've seen a massive increase in central bank holdings of government securities from about 55 billion. We've seen it rise up significantly, close to 300 billion, and with that liquidity also going up as well. So this is, I think, sort of needed at this point, because you don't want, with all the moratoriums and things like that announced, and to keep liquidity in check as well, it's very much needed at the moment. Another saving grace, I think, has been the sharp fall in oil prices. Historically, we've seen some of these falls. Recent trends are more to do with oil supply as well as the lack of storage. The forecast, I think, right now is this sort of to continue. So maybe we'll see some sort of a grace from that perspective for Sri Lanka, and it could be a 1.5 to 2 billion sort of a saving on the oil side of it. Even though maybe the demand side might slow down because we're not traveling as much during this period, and maybe in the next few months as well. From a global trade perspective, I think we've seen pre-COVID, I think this is very important to understand, pre-COVID as well, merchandise exports and imports sort of contracting as well. So the signs were there before pre-COVID of this kind of bad environment for global trade, and I think a lot of that has to do with the US-China trade war and its impact there as well. And I think this will now further continue. The World Trade Organization, for example, has put a downward projection on growth for world trade between -13% to 30%, which is a big band, which also highlights the uncertainty and also the drop that is expected. So from a trading perspective as well, I think it will be not too great a year, and might see more import restrictions, things like that, inward-looking policies by economies really also disrupting global trade as well. Just I think in terms of, and we can get this into the discussion as well, I think there will be a lot of winners and losers in this. Good to focus, I think, a lot on the winner side. There has been, I think, a lot of interest in the IT side to sort of get some of these projects into Sri Lanka, and I think this will continue probably at a faster pace. Agriculture, I think, will become a real focus, and I think you've seen policy, at least the government talking about it. We need to move from, exporting a lot of raw things to getting it more value add, and I think that's where we should play to our strengths of having commodities such as tea, rubber, and the like, getting more into that. And with what's going on, and I think with the US-China trade war, and now those tensions even flaring up in a COVID world as well, I think there will be more decisions by a lot of these global firms who are located in countries like China to relocate, simply from a geographical diversification perspective. So we might see a bit of that coming into play as well. And of course, I think the retail e-commerce side, which is very much documented as well. So that's just a bit on that. Happy to take questions as we go on as well. Back to you, Nistar.
Thank you. Thank you, Shiran. I'd like to, we'll come back to you during a few more during the Q&A. I'd like to invite Manjula to make his own opening remarks. Sorry, I missed you in the list. Manjula?
Yeah, thanks, Nistar. Thank you, first of all, to KSEEDS for inviting me to this webinar on the topic COVID-19 and the novel economic era unfolding. So as Chandranath also mentioned, this COVID-19 crisis is turning out to be a crisis of unprecedented scale, which I believe will transform the world of business. So much that people are now beginning to talk of a new normal, because everybody feels the world is going to be a very different one when we finally emerge out of this crisis. So what I thought of doing today is to share a few thoughts about the emerging trends in the world that will shape this new normal. So some of the key elements that we can expect to see. So first of all, I feel we are going to see what I call a process of de-globalization. The wave of globalization that we have seen over maybe 3 to 4 decades will see a reversal. And we are going to see countries beginning to return to inward-looking economic policies back again, like what we saw in the 1960s and 70s. And this is going to happen everywhere in the advanced economies, in the developing world, and Sri Lanka will be no exception. And we can already see some signals of that happening here as well. Then at the same time, as a second point, I feel we are going to see a massive explosion in e-commerce, which is going to change the way in which we transact business, the way we buy things, the way we work, the way we get our banking needs done. Everything is going to be done primarily through an e-commerce platform. Now, as you already know, e-commerce was on a rapid growth even during the pre-COVID days, but I would think that the crisis has given it the momentum that maybe it was looking for, which will propel it to a new period of exponential growth. And we are going to see e-commerce dominate the world of business in an unprecedented manner post-COVID. Then another kind of trend that we will see is that there will be a significant reallocation of resources between sectors, because the crisis has impacted different sectors in different ways, some to a large extent and some to a lesser extent. So, for example, we see apparel and tourism being two of the sectors that are hardest hit. At the same time, there will be sectors like IT and healthcare, which will emerge as the new growth sectors post-recovery. So you will see some kind of a reallocation of resources, capital, labor, everything moving from the sectors that will take very much longer to adjust to the sectors that will really come out of the crisis much faster as the new growth sectors in the world. Then you will also see a diversification of supply chains, and this will also happen everywhere because no one will want to be comfortable relying on a single source of supply. Now, it can be at the company level or at a country level, whichever way you look at it. Nobody will want to have that over dependence on a country or a particular supplier. So you will always try to diversify the supplier base, and there will also be an attempt to bring it within your own border, so that you have your suppliers closer home as much as possible. And we call this a process of reshoring. Reshoring is the opposite of offshoring, which is what we saw globally over the last several decades. So many of the trends that we saw in the world over the last 2-3 decades, like globalization, offshoring, are all going to see some form of reversal in the period to come. Interestingly, these reversals started even before COVID-19 hit us, but that process is going to be so much more accelerated as a result of the crisis. Again, a couple of more things. When you come closer to the corporate world, you will begin to see a lot of restructures and M&A activity, because a lot of companies, the weaker companies, will not be able to survive the crisis, and they will be swallowed up by the smarter companies who will emerge stronger. Mark the word smarter, not necessarily the larger companies, but the smarter ones who will actually come out stronger will be in a position to absorb some of the companies which are weaker, who may be financially weaker, but who probably have a good business model and who may give some value to the acquirers. So I think for the investment banks, there is something to look forward to because there will be a lot of M&A activity. And last of all, the way we work also will change because as we experienced over the last home will now become a new norm for a lot of people in fields such as professional firms as well as corporate head offices all over the world. We'll find that you can actually work from home and be productive because on one hand you're also saving the time that is normally taken up by commuting, and that can be a couple of hours for a day, which is a lot. And so this is again something that a lot of people wanted to see happen, but it is ultimately we had to wait for a crisis to really make it happen. And it will be good news for many people who are currently shut out from the workforce, particularly young females with children who have always wanted to join the workforce from home, disabled persons, people who are living in a different country, like for instance, Sri Lankans who are living abroad may now be able to work for a company in Sri Lanka using remote work because it doesn't really matter anymore where you live and where you work from in this new world that we are going to experience. So just to quickly summarize, I feel some of the key trends that we will see would be deglobalization, an explosion in e-commerce, a significant reallocation of resources between sectors, diversification of supply chains, corporate restructuring, and working from home are what I see as the key elements or pillars of this new normal. Thank you, and I will rejoin maybe during Q&A when I get an opportunity. Over to you, Mr.
Okay. Thank you very much. Thank hello. Yeah, thank you very much, Manjula, for that. All our opening remark, all our previous speakers will get a chance to come back to the discussion. I'd like to invite Amal Sanderatne to come and make his own observations.
Hi, good afternoon, everyone. I hope everyone can hear me clearly. This is, of course, new. We can't really see the audience reaction. It's a very different thing. Of course, got very familiar with this recently. One of the, just before I start off on the economics, one of the interesting thing is they said the sage of Omaha, Warren Buffett, without a stage audience, found it very difficult to give, and his whole thing that investors look for this time was very different because that audience wasn't there and it was pretty boring. So I'm trying to imagine audience here when I am speaking from home. So it's of course very different. But what is not different to us is the approach we have always taken. You know, one of the favorite quotes I've had is, you can't predict, but you can prepare. And how do you prepare? You try to imagine scenarios. Of course, what COVID did is it's just hammered you with a scenario that no one could have even put into scenario planning. And that's something, again, I think as Shiran said, in the last 2-3 years, the kind of things that Sri Lankans have gone, the scenarios and the changes we've seen, of course, unlike the rest of the world, things have hit us here, there, which we couldn't have imagined a few months before. So it's an advantage, actually, I say, for Sri Lankan businesses. We have some experience going through very negative cycles. So, you know, even our consumer and our businesses have some experience of that. For Frontier as a company, we have always been giving the scenario approach. You know, first time you hear it, you get annoyed. 3 scenarios are to do with, these guys give us big ranges to work with. You know, they won't give you a single point forecast, no decimal, you know, you'll never get what you call a decimal point forecast from Frontier saying GDP is going to be 3.5, because very much the message we've always wanted to give is get ready for different scenarios. And now, of course, this is obvious because for most of us right now, it's, you know, very hard to tell anything. Sorry. Okay, sorry. Okay, I think y'all can hear me now again. So that is very important in terms of looking forward. So on the BOP, on rates, LKR. So on the financial variables, I think it's particularly hard. The LKR rate scenario, a lot of variables around. I mean, I would say we have a bias actually that the BOP situation will be better than the very alarming view a lot of people have of it, because usually in these kind of situations, the import fall is a lot bigger than the export fall. So there's usually a improvement. So many of the scenarios we work through actually have a more favorable BOP situation than actually a pre-COVID situation. That is good for LKR and the central bank's attempt to keep interest rates down. We are, however, preparing clients for a very negative. We don't like to really talk too much about GDP, because GDP, you know, the consumer doesn't eat GDP. GDP is not what causes a change in a firm's demand for their products. So you know, we try to avoid the concept of GDP, but GDP again is a concept everyone's familiar with. So we would be preparing people for a negative number in GDP. You know, if we get something better, that's great. But in terms of the broad macro, I think businesses should be prepared and planning based on negative income growth this year, negative GDP, probably a bigger shock than you would normally see. So I would plan based on a, you know, probably a worse. I mean, I think this is, you don't need economists to say this. It's what you feel right now. Economists will just come and say, look, we've done some numbers work around this. But from a macro point of view, prepare yourselves as businesses for a very negative year. Stress yourself for volatility possibly in the LKR or depreciation and interest rates. But on that, you know, the main scenario might actually be to take a low interest rate scenario and, you know, not such a very negative LKR scenario. So that's a general broad perspective on this. In terms of what to look for, I mean, everything is evolving. So I think everything starts off here from a medical perspective, which none of us are experts. So the medical issues need to be, so if you're looking at catalysts, so things are bad. I mean, we know that globally and in Sri Lanka, things have to be get better. So first, the worry on the medical front has to ease off to a level that countries feel confident to open up to some extent. So you're seeing that now, of course, in the West and hopefully in Sri Lanka as well, you're seeing a little bit of easing, and that continues. That is, of course, almost a precondition that you have increased opening up in terms of governments allowing people to function. People's mindsets, you know, people have been in a very negative, scared feelings. So you're getting data out of China that people, though their things have opened up, they're not spending as much, scared to go to restaurants, scared to go to malls. That mindset has to change in terms of demand, in terms of getting those V-shapes and the U-shape. And then finally, of course, even if your mindset has said, people have to have the money to spend. So that's where the fiscal easing, the monetary easing actually helps out in terms of getting that recovery going. So data points related to that, the medical, the lockdown, business psychology, consumer psychology, and you know, what's actually happening on the income side are things you monitor to understand when this recovery happens. There will be a recovery. The question is when, and that's what you work with. You know, 2020 is going to be a bad year. The question is, after that, when does a full proper recovery start happening? So with that, I will, yeah, that was my overall macro perspective. Travis from my team will be giving a more sectoral perspective on how to think of it in terms of specific sectors in his presentation to follow. Thank you very much.
Thank you very much, Amal, for that quick snapshot. I'd like to go back to Dr. Amarasekara to expand on some of the key highlights that he made in his opening remarks maybe for the next 10 minutes or so, and then we'll go take some of the questions as we proceed. Thank you, Dr. Amarasekara.
Thank you. In the next 10 minutes or so, as Nistar said, let me take you through some recent macroeconomic developments in Sri Lanka. And I think I'm going to echo what Manjula, Shiran, as well as Amal said. But let me try to reduce repetition a little bit. Let me start with the key global economic developments and prospects with the spread of the COVID pandemic. Let me go back to the slides. As Shiran said, the IMF in its latest projections has projected a 3% contraction in 2020 for the global economy, compared to the projection of a growth of 3.3% that they made in January 2020. So in January 2020, they expected a global economic growth of 3.3%, and within 3 months, they had revised their projection to a contraction of 3%, a 6.3 percentage point cut in growth, which is extraordinary. The projected contraction in 2020 dwarfs the contraction of the global economy by 0.1% in 2009 during the global financial crisis. So if you look at the chart, in 2009, global economy, the blue line, contracted by 0.1%. And this year we are expecting a growth of a contraction of 3%. And this is also said to be the worst recession since the Great Depression of the 1920s and 1930s. As I showed you earlier, using some data for the United States from the website of the late economic historian Angus Madison. This one. Getting back to this, the difference this time from 2009 is that both advanced economy and emerging market and developing economy groups are expected to contract, expected to experience a contraction in growth. Essentially, a synchronized contraction is expected in 2020, followed by a return to normalcy in 2021, what they call a V-shaped recovery. Just to get an idea of how bad the global economic conditions are, one could look at unemployment in the United States. In a typical week, in the first 3 months of this year, the number of initial claims for state unemployment benefits amounted to about 200,000 a week in the United States. However, this number shot up to 6.9 million by end March, and in the past 6 weeks, about 33 million applications for unemployment benefits have been filed in the United States. Another indicator of the recession is the global oil prices, as again Shiran mentioned. Oil prices crashed to extremely low levels and negative levels when you think of the WTI due to lack of global demand for oil. And as we know, there are international collaboration as well as various national efforts by all governments to ensure speedy containment of the pandemic and faster recovery of economic activity. And when you consider the context of Sri Lanka, you might recall that at the beginning of the year, with increased optimism and improved business confidence after the presidential election, the country was gearing up to achieve above 4% economic growth in 2020. That was our initial projection at the beginning of 2020. However, the spread of the pandemic and the global economic recession projected for 2020, with these two, Sri Lanka's growth projection has now been revised downwards to 1.5% in 2020. And we also expect a V-shaped recovery with above 4% growth in 2021. Analysts are speaking of U-shaped, W-shaped, L-shaped, and other types, as was mentioned earlier. But our view is that recovery would be V-shaped. An obvious question is, what is the basis for the Central Bank of Sri Lanka projecting a positive growth, and a positive growth of 1.5% in 2020 compared to some other more pessimistic figures that are being circulated? And let me try to elaborate. 2020 is a year where projections are extremely uncertain, and I completely agree with Amal about uncertainty of any type of projections. But in 2020, projecting any macro variable is a crazy exercise. And the situation, as we know, is rather fluid and dynamic. And similar to other forecasters, the central bank forecasters at the central bank also have based our projections on assumptions. And our assumption is that there would have been positive growth in the first quarter of the year. I don't think anyone would disagree. And in the second quarter, there would be a contraction of the year, very sharp contraction. But we also assume, for the time being, that with the removal of lockdowns and normalcy returning to domestic economic activity, there will be positive, at least marginal positive growth in the third quarter of the year. And this would be mainly driven by domestic economic activity. And in the fourth quarter, there will be some recovery in global activity, and Sri Lanka will also benefit from the beginning of this global recovery in the fourth quarter. Accordingly, I think we all agree that outward related sectors will be severely affected during this year, although domestic economic activity, which is a larger part of the Sri Lankan GDP, would see a revival in the second half of the year. The IMF, as said before, has projected a contraction of 0.5% for 2020. The World Bank thinks that there would be a contraction of between 0.5 to 3%. ADB is on the positive side, think that growth would be about 2.2%. Those are the projections that we have at the time being. And rating agencies have their own assumptions as well as projections. However, we believe that many of these external agencies have not taken into consideration two key factors. One is that in Sri Lanka, the 2.3% growth that we saw in the previous year was driven by two domestic reasons. The first one, the Easter Sunday attacks, and its broader effect on the economy. And the second being the political instability, political uncertainties that we saw in 2019. And therefore, we think that it is wrong to base 2020 projections on 2019 performance and assume a growth reduction of 3 percentage points or thereabouts from the 2019 levels. The second reason is that we have been arguing for several years that Sri Lanka is not well integrated into the world economy in terms of trade. So if so, it is likely that Sri Lanka will have a lesser effect from the pandemic and the global economic slowdown compared to other more integrated countries in the world. Let's have a quick look at the fiscal sector. I don't want to elaborate too much on the fiscal sector. The medium-term fiscal path published in the annual report. Let me get to this. This is what we publish as the medium-term macroeconomic framework in the central bank annual report. This table, what we call table 1.5, in chapter 1. This gives our projections for all 4 sectors of the economy. But as Amal said, we proposed some amendments to the Central Banking Act, and with that, the expectation was that we could start giving our projections through fan charts. But unfortunately, that has been delayed. So we are following the usual format that we have been having. So when you look at the fiscal sector, the medium-term fiscal path published in the annual report projects a weakening of the fiscal balances in 2020 before moving on to a consolidation path thereafter. Part of this weakening is due to the payment of arrears from the previous year and recording of a part of debt already obtained in the previous year. Revenue collection will drastically decline this year, and expenditure will also be low. With these factors, although we see a larger budget deficit of around 7.9% in 2020, the increase in debt level will not be as high as the expansion in the budget deficit. Also noteworthy is the fact that in spite of all government's efforts to fight the pandemic and meet related costs, there is widespread understanding that fiscal space available to the government is quite limited. Therefore, the central bank and the financial system have an important role to play using the relatively higher spaces available to them. For the central bank, the fact that inflation has been maintained at mid-single digit levels for Can you hear me? Is there a mid-single digit levels for a long time has given it space to relax monetary policy and monetary conditions without disrupting inflation expectations. For the banking sector, capital and liquidity buffers, which have been maintained above industry norms, have been and are being relaxed for them to support their client base in these difficult times. Various schemes have been announced to support businesses and individuals through this crisis period, but obviously there will be unprecedented difficulties that all will have to face. And usually in Sri Lanka, when there is relaxation of monetary policy and monetary conditions, an initial reaction of the economy is to increase imports. However, this time the policy matrix is such that non-essential imports have been restricted and outward movement of capital has also been restricted. Therefore, we are in a better position to support domestic economic activity through relaxing monetary policy and monetary conditions while worrying less about these adverse effects. When you look at the medium-term path in the annual report, we have projected a drop in exports in 2020. I don't think anyone would disagree with that, but the value, of course, I mean, we will have different views. In the first 3 months of the year, exports have amounted to US dollars 2.6 billion. And during the month of March, the drop was around 43%. Tourist arrivals in the first 4 months have declined by 44% compared to the previous year. Workers' remittances have declined by 14% in March and amounted to US dollars 1.6 billion in the first 3 months, which is a 1% year-on-year contraction. There will be a reduction in import expenditure due to the reduced petroleum import bill, as was mentioned earlier, and we think that it will save us more than 2 billion US dollars this year. And there will be a reduction of intermediate goods imports with a decline in exports. In addition, there will be, we know that the curtailment of non-essential imports will also result in a reduction in imports. In addition to those items in the current account, one key item that affects the movement of the exchange rate is the flow of portfolio investment. However, as was mentioned earlier, outstanding foreign investment in the government securities market has declined to a negligible level of around 120 million US dollars, and it is unlikely to cause any further pressure on the exchange rate. And you may have noticed a sharp depreciation of the exchange rate during the month leading to the traditional New Year, but since then the rupee has appreciated sharply. And thus far during the year, the cumulative depreciation of the rupee is about 3.5%. This depreciation is in line with the depreciation of regional currencies. The Indian rupee has depreciated by 5.9%, Indonesian rupiah by 8.1%, Malaysian ringgit by 5.1%, and the Thai baht by 7.9%. And with regard to rating action on Sri Lanka, there has been a downgrade by one rating agency, while another has listed us under watch with a view to downgrade. There is concern, they're concerned about sustainability of the fiscal and external sectors. Obviously, these are areas that we also keep a close tab on, but we believe that from a national perspective, these are secondary issues that come after the people aspect of the pandemic. If authorities do not provide all required fiscal, monetary, and financial sector support to the economy to revive, fiscal and external parts will naturally be unsustainable. It is very unfortunate that rating agencies do not understand this ground reality and act as 2020 conditions are here to stay. But there are two constellatory factors as well. The first is that rating agencies have taken similar action on many economies, and therefore Sri Lanka's relative position in the rating matrix is likely to remain unchanged. The second is that with the yields on Sri Lankan ISBs that we have seen in recent months, it is unlikely that Sri Lanka will rely on the sovereign bond market this year. Instead, the the fiscal authorities are discussing with bilateral and multilateral partners to raise required funding for the government. Some of these discussions are at advanced stages. This will result in reduced borrowing costs to the government as well. And at the same time, the greater reliance on domestic resource availability will also result in reduced borrowing from abroad this year. Serious concern that all of us have is the loss of livelihoods of people from the pandemic, as well as the lockdown measures. Sri Lanka's shadow economy is estimated by Frederick Schneider. There is an interesting IMF paper on this, and they estimate Sri Lanka's shadow economy to be about 36%. Sri Lanka's informal sector employment has been estimated at 59% by the Department of Census and Statistics. Informal employment, including casual workers in the formal sector, amounts to about 68%, according to the same source. If you consider the most affected sectors in terms of unemployment, I think Manjula mentioned these would be travel and tourism, apparel, and other export-oriented sectors, as well as the construction sector. In addition, the so-called gig economy will get affected. It would have got affected already to a great extent, and there would be job losses for Sri Lankan workers abroad. One silver lining is that once the lockdown is removed, given the large informality of employment in Sri Lanka, it is likely that employment will see a quick pickup as well. And the government has taken several measures to ease the burden on vulnerable segments of the population. But it is essential that a formal mechanism of nationwide contributory pension and social protection system is established as a national priority. There must be a system for the informal sector workers to contribute to this system during better days and depend on it when times are difficult. So in conclusion, I would like to argue that there is an urgent need to get economic activity back on track. But obviously, given the health concerns that Amal highlighted, this requires concerted efforts of all segments of the Sri Lankan economy and society. In the short term, there seems to be no point discussing revenue-based fiscal consolidation or debt sustainability. And also in the short term, there is also, it doesn't look like there is any point discussing inflationary pressures. These are macroeconomic stability issues that can be dealt with later. And as Manjula highlighted, many aspects of our lives will change. The way we work and the way we think of work will change. And our savings and consumption patterns will change. The way we think of domestic production and trade will change. I would also like to argue that although events like this will force us to think afresh, it is too early for us that the single data point that is said to be seen every 100 years or so will result in a so-called new normal, or whether it is just a short-term abnormality. With that, let me stop and we can continue the discussion. Thank you.
Thank you, Dr. Amarasekara, for. Thank you very much, Dr. Amarasekara, for that fairly detailed presentation. We have one more panelist to speak, that is Travis. It's your opportunity now, Travis, to make your presentation.
Hi, good afternoon. I assume you can hear me and see my screen. In the interest of time, I don't think I'll be able to go through my presentation. I just want to, and also I think most of the panelists have kind of touched on the areas I was hoping to speak on, which was to give you a framework for how to think about in terms of how businesses and sectors would evolve in this new normal. And I think Manjula said it very well. He highlighted some of the key things that a lot of businesses would be thinking about, like deglobalization, e-commerce, how these trends are going to affect businesses going into the future. So I just want to highlight just one slide that is more or less echoing what Amal was also emphasizing that this need that you need to prepare for different scenarios. So it's so I mean right now, I mean, it's difficult to say exactly how things would pan out, but the important thing is when it comes to your business planning, you need to be prepared that there can be very different sort of outcomes that could take place. So just to highlight one example from tourism, there are, I would say, from the sort of evidence we have seen and the kind of articles that are going around, there are like broadly two wide ranging schools of thoughts on this. So one is this concept that has come up of what they call revenge traveling. So the idea is that, you know, you've been cooped up in your homes for like so long, you know, you've also like not been spending on anything else, you have this money saved up, that you'd suddenly, you know, once the restrictions are lifted, you'd want to go out and start traveling. And so this has particularly been a view shared, particularly with regard to Chinese tourists. So there's been a surveys done in like, I think at the end of March and in April. And a lot of it was, the respondents were saying that they were getting ready to start traveling once again within, you know, the next 3 to 6 months. And so if you buy into that view, the expectation would be that, you know, businesses would get back to normal, you know, hotels would be operating in a similar way, that the tourism sector in general would be operating in a similar way than what they have in the pre-COVID era. So that's one school of thought. But at the other extreme, we might be going into something like this, where, you know, traveling in person may be the exception. And most of the time, what most people will be able to do might be to go on these virtual tours. Like, if you've been following in a lot of museums, they have been offering these online virtual tours of their museums. And interestingly enough, if you go back to a lot of the museums' histories, one of their early objectives, and if you take some of the things that were done in the 19th century and early 20th century, there were these world fairs that were conducted. So the objectives of those was really to bring the world to you, because most people won't be able to afford to travel. It was also very hazardous to travel. So maybe we might see a return to that kind of arrangement. And also in our context, facilitated by technology, like VR goggles and things like that. So the message I want to leave you with is there's a lot of uncertainty. So I mean, what you can do is to look at, to think through what are some of the different factors that can affect you, and try to map out what are the different scenarios and plan your business accordingly. Thanks, and happy to discuss this further during the Q&A.
Thank you very much, Travis, for a quick snapshot. I think we'll try and get you back into some of the insights shared. I have a few questions, but I just want to perhaps ask the panelists. I think I see divergent views about the post-COVID recovery. I just want both Shiran as well to come into the discussion. How credible has some of the measures been so far? I mean, maybe there was a reference to government not having enough fiscal space in terms of really doing something. Has the stimulus really worked, or is it too early to make an assessment? Because we have seen deadline for applications being extended further, and there is no real coordination taking place. What's the real situation in terms of business recovery? I'm talking about short term, getting back to business, and in the next 3 months. Amal and Shiran, maybe you can give some insights. Is Amal there? Shiran there?
Yeah, Nistar. So as I mentioned, I think it's mainly the monetary lever that has actually been used. And if you look at the 50 billion in the context of what the total outstanding loan portfolio, for example, of the banks, it's a very small factor. So I think a lot of the fact of not enough firms maybe getting access to it. If you divide that 50 million even by 5 million, that's 5 million per company. It's very limited amount that or limited reach it'll have. So I think it goes back to the point of the whole stimulus. I mean, you look some countries have really looked at both the monetary side, what the central bank is doing in terms of its open market operations, keeping liquidity in play, but also stimulating it through some fiscal measures. That has been very weak, and that's something we've been calling for it to be much more wider, targeting the daily income workers, targeting the households as well as the firms. We do have some of it given to.
No, I just like to. I mean that fiscal that space may not come for the next 3 months or so. Let's assume it's not going to happen till June or after. What are the prospects of a quick recovery, getting back to business situation?
In the absence of that, I think there will be a lot of difficulty, and I think there might be, a lot of restructuring, things like that taking place, cash flow. I mean, you're hearing a lot of things like pay cuts and things like that. So we might see more of that unless there is real support in that. The domestic recovery, which Chandranath mentioned, I think then has to really come up. We really have to see some of these things coming into play to keep that cash flow between the suppliers and the businesses and the workers.
Okay, Dr. Chandranath, any insights? In the absence of fiscal support?
Is an extremely difficult question and extremely difficult situation as well. And I think what we are trying to do from the central bank side, and I think the entire financial sector is also behind us and the government. We all understand the difficult situation and that the government is in spite of all the rating concerns and the ballooning of debt and higher budget deficits. As the central bank, we have been. I spoke about the spaces available in the monetary sector and the financial sector. So what we are trying to do right now is to utilize those more, which is probably different to what's happening in the other countries. So thus far during the year, we've.
No, I understand. What I'm thinking. Is central bank happy with the kind of speed in which this working capital loans, that kind of support I'm talking, and also central bank reducing interest rates or policy rates so often sends a very conflicting message that central bank doesn't appear to be having confidence in terms of some of the actions it has taken previously. How would you respond to that?
So obviously, the things can improve. Right now, the financial sector is receiving applications. They've received a substantial number of applications. I think in various fora this has been discussed, and the financial sector is processing them. And as the central bank coming through the guarantee schemes and refinance schemes. Also, we've been having constant discussions with them. But obviously, because of the dynamic condition of dynamic nature of this situation, we feel that continued action from the central bank should also continue. Basically, that's why we have seen every month 1 or 2 monetary policy action in addition to the other measures that are being taken. So this is what's happening in the other countries as well. So just during this year, I think there have been more than 250 monetary policy easing decisions taken by central banks around the world. So 250 is a quite large number, and this has not happened just once. Continuously over the past 5 months, and I suppose until the recovery continues, this process will continue.
Okay.
And at the same time, I think in the DFT today. I mean, you've highlighted very correctly that we have tried to, in our press release, we have tried to highlight our position that if by any chance interest rates, market lending rates are not brought down, there will be regulatory action pretty soon.
Okay. You in your presentation, you did mention about moving towards a single-digit interest rate. I mean, I like the private sector people to respond to that. Is it a sort of is it a fairy tale, or will it really happen? Not because of anything, but because of the directly because of the COVID situation. Amal and Shiran, quick response to that. Single digit.
Okay, let me answer. I just want to actually say something about the central bank and this query you brought, that the central bank is changing its monetary policy decisions and it causes a lack of confidence. Look, number one, we are dealing with a virus that no one has understood, that's mutating, and how it's spreading. It's not predictable. It's not like the medical people here or overseas have good predictive. It's a very difficult thing. I mean, you may think that, I mean, I'm an economist. I know how hard it's to predict the economy. This is a completely new thing, how it spreads, how much it spreads. First, we don't know what's happening on that side. Then after that, we don't know how we should be responding to it. So the public health authorities and how what level lockdown they do, no one knows. Then the economy moves according to how multiple lockdowns are happening around the world. So one thing I'm doing with our clients, when we present to them, we have a very unusual disclaimer. We say anything we tell you today might very well be very different in a couple of days' time. Very unusual. I never said anything like this. Because that is the reality. If I'm going to act like I have a perfect understanding or that my advice can stay as it is right now, and I understand the future in this completely unusual situation, I am giving you a sense of confidence about the future. That's not correct. I think it is actually correct for the central bank to take continuously evolving decisions as it comes, and the public should understand that. Business should understand they have to be reactive. They don't know the future. They react based on the data coming in a completely unprecedented way. So just to give that point of view, because I need to keep changing my forecast as well. So
no, I know this is more largely because of perhaps the refusal of banks to reduce the rates. I mean, that's what it reflects. Nothing about COVID. The unknown enemy here.
So the banks also have a problem, Nistar, because the banks have to also figure out now I also don't know the future. I have to react to this and make decisions. It's fundamentally a really tough environment for anyone to live in, right? Even the businesses and even the bank CEOs, I understand. Everyone is in an environment that is completely strange. About interest rates, are we living in a single digit? So, we have always at Frontier, typically at the forums, had this view that interest rates in Sri Lanka, it was very easy. Every 4 or 5 years, Shiran knows this, I think most of you all have seen a present, we call it the up-down cycle. Rates come down, people start spending more, the government goes and busts the fiscal deficit, rates go up. Then IMF comes in, tightens up, rates go down. And I thought the life was going to be easy. This is going to be easy. Every 5 years, we have this cycle. Now we have a 1 in 100-year pandemic. Now, I am not sure whether this cycle of rates going up again in this pandemic, because if you study interesting academic literature you get on pandemics in like the 1600s, 1500s, now you're going back cycles of 200, 400 years ago, it causes sometimes changes in psychology that keeps interest rates down for a very long time. If you go back in the 1930s kind of situation globally, which means the global economy is highly depressed, and negative interest rates are the norm globally, then it can be a very different situation for Sri Lanka. So we are in what I used to call the usual up-down cycle in Sri Lanka. That used to just keep happening, and if rates come down, just bet on it going up again. I wouldn't do that anymore, because you've been hitting a 1 in 100 or 1 in a 30 or 40-year thing that is not part of our normal cycle.
Okay, good.
Does that help?
Yeah, thanks. Shiran,
if I was to add to it, I think we've seen even the AWPLR, the prime lending rate at single-digit levels in 2014, early 2015 as well. So we've seen, as Amal mentioned, these cycles. The interesting part here is beyond COVID also, I mean, previously you needed a higher interest rate to attract foreigners to come in to the T-bonds and the T-bills. Here you're at this point where there is no point. Even if you have, central bank raises it 5, it's not going to really matter. So there is no in terms of that, there is no risk. And I think at least in the next 12 to 24 months, in particular for businesses, with beyond even thinking of investment, just to keep things going, have loans for working capital side, I think you might need to have this prolonged low interest rates, whether it's 6%, 7%, which sometimes have not been sustainable, or whether it's, you know, keeping it around 8, 9%, at least the prime lending rate really will really matter. And I think the central bank has to, I mean, they've already looked at those, but also ease some of the liquidity concerns for the banks, in particular the NBFI, so that I think we've historically seen even last year, the pressure is put on the banks and the financial sector. We don't want that to be under too much stress and carrying the burden for the rest of the economy. So that ecosystem also needs, I think, protection as we think about a recovery.
Okay, good. Thank you. Can you take the question from the audience? I'd like to I think this is to Dr. Chandranath about money printing. Where will central bank draw the line?
Okay, so this is a famous topic that we like to discuss from time to time, I think. But I think this time, maybe I shouldn't say this, but this time it's different because, as I said in my presentation, there are two concerns that we usually have with money printing, which in technical terms either refers to the increase in reserve money because of one of the two reasons. One is subscribed into government securities, or increasing currency in circulation. So this time, I think what's happening is that because inflation has been low, and because inflation has been low due to the subdued aggregate demand conditions, we have been able to support the government's actions in the national interest by providing funding for the government through the purchase of treasury bills from the primary market. Obviously, this is not something that we should practice going forward for a long period of time. But what are the risks involved? So, as Shiran and Amal mentioned, the one risk that could arise is, imports increasing, with private consumption increasing and government consumption increasing. It is unlikely that that would happen this year because of all the other dynamics. And the other concern is inflation rising. So that is also not a concern. So right now, I mean, we have a very large amount of over 300 billion stock of government securities with the central bank. That was at a pretty low level about 2 months ago. But right now, we are not too worried about it. A part of that, about 80 billion, was purchased by the central bank from the secondary market for open market operations, and the rest has been purchased from the primary market. And altogether, we have about 300 million rupees worth of stock of government security at the moment. And as I said, we are not worried about it right now.
Okay, fine. Shiran, just want to know, do you feel, I know you made a lot of recommendations to the government with regard to recovery phase. Do you see some of the ideas from the private sector taken on board? And do you see the implementation? How has been the implementation, and how confident are you in terms of the recovery strategies?
So at least on the financing side, I think now we're seeing the approach to look at either debt moratoriums, bilateral funding, I think the approach to the IMF. So on that side, some of the strategies have been put to work and I think are rolling as Chandranath mentioned. We have also, I think, in terms of money printing, also, I think coin it may be a bit different. I think it's our version of QE, in other words. So maybe we'll use that word without saying money printing. So that is also something I think necessity in the absence of real fiscal stimulus just to keep the economy sort of going. Some of the more other related, I think on the labor side, we're not really seeing too much of assistance. I think there are real industries such as on the apparel side and also on the tourism side, which really need employment support. I think that has been lagging, which I think we're pushing forward for. Some of the other things I think the government is trying to do through the Samurdhi system in terms of income, cash transfers and things like that. So it's a mixed bag at the moment, but we're hopeful that in the next few months some of these things can be really looked at. And I think from a tax point of view also, we've given a lot of submissions which I think will help in the medium to long term in terms of the recovery side of it.
Okay, fine. Thank you. I want the panel to make a quick take on the capital markets. Anyone in the panel can respond to it. Capital market, what's your own outlook? Whether I know it's closed for a while, but what are the prospects given the interest rates are going to be very, very low?
If I may come in there, Nistar, I think for a start, we have to open the market as quickly as possible because they're not giving the right signal, keeping the stock market closed for such a long period of time. And when most of the markets elsewhere are open, because when we go to target foreign investors in time to come, I mean, this is going to become an issue. So we need to get the market back on track. Okay. So when it does open, yes, there is a possibility of a downturn. I mean, we have to expect that. But usually what happens is how markets react to this kind of a situation is it always tends to overshoot and then tend to kind of readjust. So my prediction is that when the market opens, yes, it will go down. But when it really gets to a point, I think it will attract a lot of serious investors back into the market. Particularly the large institutional funds will see a lot of value, and it will sort of bounce back. May not be back to the same level, but that will take time. But it's not going to be a one-way street.
Okay, thank you, Manjula.
If I may add to what Manjula said, I completely agree with what Manjula said. That we should open the stock market as soon as possible. If I take the example of the government securities market, foreign investment in the government securities market, the assurance that we have given the foreign investors in the government securities market is that under no circumstances we would allow, restrict outflows from the government securities market. So if a foreign investor brings in funds, then they should be allowed to take those funds out at any time. So that assurance has been given, and that's what we have been following in the most difficult times in 2009 as well, and that has worked. So when they want to exit, they exit, but at the same time, when the conditions are better, they tend to come in because they have the confidence that the outflows are also facilitated by the regulators.
Thank you. Next one is on the property real estate market. Any bets? How will it be? There have been huge investments that have gone into the property and real estate market. It's something that is no one has really assessed how it will be going forward. Any insights from the panel?
Hi, Nistar. Yeah, I'd like to. So if I just sort of use the framework I was trying to introduce in terms of how to think about it from a sectors or a business point of view, I think it very much depends on the type of real estate, as well as what is your assessment of what will happen in the long term. Whether does the incident cause like a permanent change in terms of your the outlook for consumer behavior and things like that. Because when it comes to real estate, it's a long-term asset. So they are not. So if you're deciding to go for a construction project, you're not just thinking about how the consumer is behaving for the next 2 to 3 months. You're taking it at a much longer period. So really, what you need to assess, I think, a critical thing is whether does consumers' behavior change in the long term as a result of this. Will consumers no longer want to live in apartments, or would they want to go from like smaller apartments where there isn't as many units per floor? Then when it comes to the retail malls, do people have, as a result of the situation, the lockdowns, they've been forced to like look for alternative entertainment venues. So in that situation, are things like going to a shopping mall, going to the movies, is that going to happen as frequently as it was before? So what does that do in terms of the attractiveness for malls? Then coming to the commercial space, so I think on the 11th, offices are starting to open up, but will it look very different? So I think in the immediate term, some of the officers might need to think about what are the sort of the disinfection protocols they would have to implement. Another trend that might reverse is there has been a trend towards more open office planning. Maybe that might take a step back. Would that be a temporary thing, or is it permanent? What about the trend when it comes to co-working spaces? Would that remain, or would that also have to change? So I think when it comes to real estate, since it's a long-term asset, I think it very much depends on your assessment of the consumer. So in the short term, you would have these pressures in terms of consumers being constrained in terms of they don't have spare cash to invest. Their priorities might have changed. But I think the key thing is in the long term, making that assessment.
Okay, thank you. Anyone, any insights from the rest of the panel? Just before we wrap it up, because we've sort of shot up by half an hour. Shiran, on the overall construction sector, I'm not talking about the property, but what's the outlook for, because that's a critical sector for the economy, and then there's some pressure to restart it as fast as possible. And I think Dr. Chandranath would agree that government is going to support the construction sector to get that 1.2% or 1.5% growth forecast for 2020.
So I think pre-COVID as well, the sector was struggling in terms of cash flows. I think some of the road development and things like that, which there were state dues. So that was having an impact on the system. Right now, I think the issue is also for them in terms of salary. They are not directly hit, but indirectly hit because everything is closed. Going forward, I think the issues that they've had historically will continue in terms of labor, cost of production, a lot of things like even imports being very high, things like even steel, scissors and panel and things like that. So those I think will continue. I mean, it's in terms of GDP, construction is almost as high as agriculture. So the weightage I think will be placed towards it. But from the infrastructure side, I think this is where the government will need to prioritize whether you look at getting construction going by prioritizing public investments, big highway spending, things like that, which will then starve some of the expenditure that can be utilized for COVID recovery, or will they, spend it on things like construction to boost that sector and let that get down to, the value chain within the system. So that's an interesting call, I think, for the government to take.
Thank you. Chandranath, any inputs?
I think I agree. Basically, I mean, the signals that we have been getting from the government is that, okay, the public investment will be affected because of two reasons. One is that anyway, we are under vote on account and the proper budget will be presented in the second half of the year. And the second one is that because it is likely that recurrent expenditure will increase, that will have a hit on public investment. But the government is keen to support the construction sector. Perhaps the small scale construction projects, infrastructure projects will continue. And the government has also invited the large-scale investors to come in and build infrastructure, and so basically other types of models to build large-scale infrastructure. I think they are planning it for the several types of infrastructure projects that we were talking about earlier. And then Port City, there is a lot of uncertainty surrounding construction in Port City. That's something we'll all be watching closely. But for domestic construction, there will be at least the arrears issue is of course there, but with interest rates coming down, and if we can get interest rates on housing loans, that kind of interest rates to low levels, then I suppose that will give a boost to the construction sector, and as well as the provision of supplies to the construction sector as well.
Okay, right. Thank you. I'd like to thank the panelists for their time. I'll just thank you very much for being very frank, given the limited time. I'd like to hand it over to Anjana of K-Seeds to follow it up in terms of wrapping up. Anjana, are you online?
Yes. Thank you, Mr. Cassim. Ladies and gentlemen, we've come to the end of this program, but before winding up, let me mention the eminent panel who join us today for this interview, for this webinar, starting with Dr. Chandranath Amarasekara, Mr. Manjula Silva, Mr. Shiran Fernando, Mr. Amal Sanderatne, and Mr. Travis Gomez. Amidst their busy schedules, they made their time to feature on this panel today to share some valuable insights and their contemporary know-how. So on behalf of K-Seeds Investments and all the viewers today, I would like to thank you, gentlemen. And the moderator for this discussion, Mr. Nistar Cassim, thank you very much, sir, for facilitating an effective discussion right throughout the session. And also, I would like to extend our appreciation to Ceylon Chamber of Commerce and Daily FT for partnering up with K-Seeds to make this event a success. And last but not the least, I would like to thank all of our viewers for their participation and the enthusiasm they showed in this event. And ladies and gentlemen, we'll be signing off, and we're looking forward to see you again in another interesting session in near future. Till then, goodbye from all of us. Thank you very much.
Thank you.